Sometimes I feel like if their underwear didn't get crusty, the Fed Board of Governors wouldn't change them. What do I mean? You've got Bostich and you've got Kashkari and you've got a couple of other cats who are out there saying, hey, we need to keep rates high. Why are they saying this? Because they don't look at the data and comprehend it. In fact, if you take a look, these same people now that are the super hawks back in August, July of 2021, they were saying, no, inflation's good for us. We need this inflation. It's going to help our economy. So they did nothing. Even as the mortgage industry was saying, hey, y'all, let's go increase these rates a little bit. We're about to get in trouble. These guys are saying, no, we know better. Now they're afraid of being thought of like the 1972 Barnes Fed. And they don't want their legacy to be, hey, we effed up. So what are they doing? They're saying we're going to stay on the same course. They've got blinders on. And they've even said, Neil Kashkari was saying that he believes that we need to cause more pain. He wants to keep these rates higher, the Fed funds rate higher in 2024. Now, we don't see that happening. One of the challenges with the Fed is that the market seems to be leading the Fed. The Fed is not leading the market. Now, the Fed can print more money. They can take money out of the money supply. But look, we're capitalists. The dollar is generally going to win. So what do we have coming up that's going to be influencing rates? Next week, Powell's going to speak. Today, of course, we've got the parade of Fed governors that are going to be speaking. Also next week, though, we've got the job reports. And it's the jobs report that started all of this craziness on February 2nd. What do I mean by it started all this craziness? On February 2nd, we received that last BLS jobs report with the one time a year population control effects and things of that nature. So we had this overly optimistic, bloated jobs report that said we created about 900,000 jobs where we actually lost about 2.5 million. This is an issue. But when we get the next jobs report, we're going to see a more real picture because it's going to be truly a month-over-month comparison. There's not going to be all that statistical pencil-whippery that we have had. So we should see this being very, very positive for rates. We've got ADP and the BLS report coming out, so we should be good. Let's talk about real estate inventory right now. It's interesting because properties are not moving quite as fast. There are less buyers in the market. But if we take a look at inventory is still really tight. Nationwide, there are about 980,000 homes that are listed. And of those, 402,000 of them are currently pending. So they're essentially off the market. What does that mean? Let me boil it down to gravy. We have about 1.43 months of inventory. Now, this is not a historic low. In fact, during the pandemic, we got much lower than that. But this is still probably about half of what the normal inventory is for us. So as rates are currently higher right now, this does present an opportunity. What do you mean, Rich? It's presenting an opportunity. There are less people who qualify. Less people can afford to buy right now, which means that as a buyer, you are somewhat in the catbird seat. You have the ability to negotiate a little bit more. But as soon as rates drop a point and a half, what are we going to see? An additional 5 million buyers. So we already have this constricted inventory, 1.43 months. When you add in additional 5 million buyers or 5 million potential buyers, what is that going to do? That's going to put a lot of upward pressure on pricing. We still do believe that as we're going to be getting the CPI numbers coming out in May, June, July, August, that we're going to see that the inflation number is going to drop dramatically. The other thing that we're looking at as well right now is we're seeing that the labor participation rate is extremely low. One of the things that the unemployment rate does not factor in is folks who just said, I'm out, done. These folks don't have jobs. They're not looking for jobs. They haven't looked for jobs in a while. Because they haven't looked for jobs in a while, because they're not collecting unemployment anymore, I'm not exactly certain how they're living, but because they're not doing that, what does it do? It tells us a false unemployment number. In fact, it shows that our unemployment is really low. But that's also an interesting thing too, because recessions start when unemployment's at its lowest. When unemployment starts increasing and increasing, that's because of the effect of the recession. So despite what Kashkari says, despite what Bostich says, we are actually in a time of economic turmoil. I don't know if you feel it. I personally feel it when we go to the grocery stores and things are a lot more expensive. And also I'm seeing friends that are losing their jobs. That being said, if you're trying to buy a home, this is a great opportunity. Why? Because right now you can be more aggressive on trying to get a good price. But once we see the economy slow down and the Fed opens their eyes and the markets open their eyes and we see the rates falling, you're going to be able to refinance. So you're locked into your purchase price, but when you go to refinance your mortgage, you're going to be in a much better space. If you've got any questions, please feel free to give me a call. This is Rich with Cross Country Mortgage.